Hello, everyone, and welcome to the Bloomberg Sustainable Business Summit. Right now, it's fair to say that companies and investors across the world are facing plenty of uncertainty. But investing isn't just about managing risks, it's about seizing opportunities. And this summit is all about helping our customers seize more of those opportunities in climate finance and sustainability. At Bloomberg, we're using less energy and getting more of it from clean sources. Plus, nearly all our profits go to Bloomberg Philanthropies, which helps fund clean air and clean energy initiatives around the world, including our partnerships with national governments in Asia, Africa, and Latin America. The fact is, fighting climate change, promoting economic growth, and creating good-paying jobs really do go hand in hand. And at Bloomberg, we're committed to being your partners in that work. So thanks again for joining us. And I look forward to hearing about the new work and partnership that grows out of this summit. All the best.
Being woke has been vilified.
The idea of sort of climate and as a priority has really, frankly, diminished.
Growth fears and tariff fears directly impacting the market.
We need to spend on defense fast. Hundreds of billions will need to be spent immediately.
AI promising, of course, to transform the global economy, expected to place huge demands on energy.
To deliver a return. They are investing in this space because they see it as delivering profitability, adding value. This isn't like altruism or charity.
It may be quiet, and you may have all institutional and business executives not wanting to put their hand up, but they're putting their money into clean energy.
Large corporate industrial players in Europe are waking up and saying, okay, we can now partner with climate technology startups and lead this decarbonisation in a very profitable way.
Please welcome to the stage Abby Danzig, Senior Editor of Bloomberg Live Experiences.
Good morning, everyone, and thank you so much for being here with us in our London office during what I'm sure is a very busy week for all of you. I think it is hard to find an industry that isn't in the middle of disruption right now, but for those of you working in ESG and sustainability, I think you've been riding a wave of chaos for maybe the past couple of years now. Whether it's regulatory whiplash, shifting business priorities, or an influx of political and personal opinions on these issues, you're no strangers to chaos. But today is not about the problems. It's going to be focused on the solutions and how this work is inherently tied to risk management, resilience, and business value. Before we begin, I would like to acknowledge our summit presenting sponsor, Schneider Electric, as well as our participating sponsor, Envision. And a few quick announcements. Wi-Fi details can be found on the back of your badge. We will also be doing some Q&A and polling today, so make sure you look on the screen behind me for QR codes for you to scan and submit your questions and get your votes in there. And then also please follow us on social media, and any posts that you have about today, use the hashtag #SustainableBizSummit. We would love to engage with you on there. All right. I am very excited to welcome our next speaker. You heard some very powerful words from him in our opening video. Please welcome to the stage Chuka Umunna, Global Head of Sustainable Solutions and EMEA Head of Green Investment Banking at JP Morgan, for a conversation with Bloomberg's Francine Lacqua.
hope everyone's doing okay on this fine day. Chuka, thank you so much for joining us. Now, we're going to focus on the solutions, we're going to focus on the positives, but actually, what do you tell someone who's a bit depressed, who's been working on sustainability and ESG for a long time, and this year it just feels a bit blah?
Well, look, the transition will ebb and flow. It will never be linear. It will go up and down. But actually, I mean, we'll go into it. I think the debate has moved on a bit relative to this. Are you for or against investment in the transition? Do you believe this is a hoax or not? All of that. I think the debate.
It's happening. It's happening, and people are still investing, just maybe more quietly.
Well, look at the figures. If you read some of the headlines, not of course the more accurate headlines in Bloomberg, you'd think that everybody is pulling back from this thematic. But, public sustainable AUM is at about $3.2 trillion at the moment. The US was not necessarily historically the big driver of that. Around 85% of the AUM in terms of where the funds are domiciled is European. And then if you look more specifically at investment in the energy transition, and the figures are courtesy of BNEF, of course, but you had 2.1 trillion invested in the energy transition in 2024. 39% of that was mainland China. If you look at Europe, I consider the UK to be part of Europe. It was about 21.2%, and then the US was, 16.2%. So the US was never like the massive driver of this. And actually what the previous administration in the US was trying to do was obviously to pull the US up the rankings through the Inflation Reduction Act. But how I think the debate's moved on is I don't think it is any longer just about what you think about sustainability. It's about how you can achieve greater energy dominance and energy abundance. And that is something that the US administration is absolutely committed to. And I think the second thing for me is that the interplay between geopolitics and these energy supply issues has never been more pronounced. And we've seen that play out through the tariff tensions and the trade war since the beginning of the year. So I think the fulcrum around which the debate is moving is away from for or against sustainability towards how am I get my energy and how does this shore up my position on the geopolitical playing field.
But Chuka, I mean, going back to the US just one second, it's clear that the president said he's no fan of the green transition. So if you look at the, as you laid it out, US, Europe, and China, is the US going to fall further behind in the green transition?
If you don't see levels of investment continuing to go up and everywhere else is ploughing money in, then the US's relative position may fall behind. But I don't think it is a given that one administration necessarily dictates the course for the whole of the US going forward. So I think you'd be a brave person to make a call on that right now. And of course, as I said, the administration wants energy abundance, and to achieve that, you need a kind of all of the above approach. And so they're incredibly interested in nuclear, very interested in geothermal. If you look at the US Congress, there's a degree of bipartisan support for some of the different types of hydrogen. And that's because we're all having to deal with the increasing energy demand from AI, electrification, rising temperatures, which of course mean that we use more energy. And then you've of course got the energy demand coming from the emerging world. And as their GDP per capita increases, so does the energy demand. And actually, if you look at the increase in the energy demand last year, 80% of that was coming from the emerging world. And actually, just take India alone, it accounted for more of that energy growth than a whole load of developed countries combined. So you take those set of factors, we need more energy. Where are we going to get it? And it's kind of, frankly, an all of the above approach to achieve energy dominance.
On the big, beautiful bill from the US, where does it leave some of the green energy and green transition? Could it be called, as you suggest, other things, but still go in that direction?
Who knows what parts of that survive? I think you also have to understand the motivation. The motivation there is how to pay for the renewal of the 2017 tax cuts. That is the ultimate goal. It is not necessarily how do we go hacking away different support for the green economy. That is like a secondary consideration. I think in Congress, it's more how can we find the money to pay for the renewal of the tax cuts, which I think over a 10-year period, you're going to have to find at least $5 trillion to pay for that, and the revenue that you that I think is forecast to come in from tariffs. I mean, who knows where they will land when the end of the pause comes up on the 9th of July. I think the consensus view is the revenue from the tariffs isn't going to be enough to pay for the $5 trillion cost of renewing the tax cuts for another 10 years. So where are you going to get the money? And I think it's more kind of a deficit and funding issue than it is a sustainability issue.
So where's the money when you look at some of the emerging markets that you mentioned? Where's the smart money being deployed right now on sustainability?
Well, generally speaking, about a third of energy transition investment is going into electrified transport. About a third is going into low carbon energy and renewables. We're seeing a bit more of a diversification of where the funding is going from, but those two in particular, and also investment in power grids, is dominating. I think in the short term that is likely to continue, but the diversification in the medium term should tick up. And one thing that we are beginning to see, I mean, obviously, certainly if you look in the public markets and green economy stocks, it's been a very tough ride since the end of 2022. But it does look like there are some, at least short-term signals indicating perhaps we're now at an inflection point. And if you look, say, for example, at the performance of the eco index over the last month, it's actually outperformed the S&P 500 and the NASDAQ, which it has certainly not been doing over the last 2 to 3 years. And some of the things that have been an impediment for the onward march of green economy stocks, like the higher rates environment, supply chain issues, permitting and planning reforms, there are quite positive signs that some of that will be resolved. So although our strategists in JP Morgan Markets are forecasting there will be a degree of inflationary impact from the tariffs, we still see nevertheless some monetary easing. We're calling a couple more cuts from the Bank of England this year, at least another one from the ECB and the Fed. And so that should hopefully help green economy stocks. And of course, on both sides of the Atlantic, there's this huge focus on planning and permitting reform, which will also help many of these companies.
What accelerate in terms of what just getting it to market?
Yeah, removing the red tape and the impediments to never mind being able to get the finance, but actually being able to build the projects. In the private capital space, again, good signs, positive signals. There were $32 billion worth of funds raised in the private capital space. EQT had a very big one, as did Blackstone. But I think the key things there for companies raising money in that space, and look, the problem here is not a lack of capital, it is a lack of investable, bankable projects as ever. And if you've got a good management team, you've got solid offtake and contracted agreements, you've got a decent cap stack with credible investors and proven technology, people don't want to fund a science project, you can raise money. And so in the private capital space, there is a decent level of activity. The drop that we saw between 23 and 24, we haven't seen a drop. We're kind of so far at the beginning of 2025 on a level with where we were at the end of 24. So I think actually there's quite positive signals, but it's not like companies investing in this space have been immune from the impact of what all companies are seeing, and
And that's trade and that's tariffs.
Yeah, well, I mean,
if CapEx in general, right?
Yeah, I mean, you look at the investment banking industry. If I just move away from strictly the green part, yeah, I mean, companies have been having to deal with the geopolitical uncertainty, the Middle East conflict, the tariffs, and so forth. But they're not panicking. They have come into this period of uncertainty with strong balance sheets, a strong liquidity position. They've traded reasonably prosperously over the last few years. So this is very different, if you like, from say 5 years ago when people were going into COVID and there were massive worries around liquidity. People's balance sheets weren't as healthy. They hadn't been trading so strongly. So generally speaking, what we see, across our investment banking business is no panic. We have had a lot of our deals paused, but people are not pulling them. Okay. They are waiting to see things settle down. But we've got a very, very strong pipeline on the M&A side.
On green deals or deals in general?
Deals in general. And then, if you look at the equity markets, now we're obviously at the same level or above if you look at the different equity indices as we were Liberation Day. So the kind of sense of hope and optimism is there, but nobody has the confidence with conviction to call the outlook at the moment, just given the uncertainty. But if the uncertainty recedes, then I think you're going to see a lot of deal activity. You'll see more companies coming to market.
I mean, financial institutions actually, you know, a lot of them quit, including your bank, from the Net Zero Banking Alliance after Trump was elected president. Does it make a difference on running day-to-day, on capital available? Does it make a difference at JP Morgan, or do you stick to net zero targets?
We decide what we're going to do irrespective of any of these broad coalitions. Not to do any of them down, they will have their role to play, but technical membership of an organisation doesn't dictate what JP Morgan does. You know, we're a bank that handles $10 trillion a day. But for us, this is an essential part of our business. Jamie Dimon, our CEO, has been very clear publicly that we want to be the bank of choice for companies wanting and needing advisory to go on the path of transition or to raise finance. We have one of the biggest green investment banking businesses in the world. We made nearly $1 billion in revenue from green transactions or green companies last year. So as for our clients, as for us, this is a really big commercial opportunity. And you leave the field, you'll miss out on the opportunity.
I mean, there's also this fair access to finance, you know, bill that's under consideration in Congress. Again, what does that mean for banks' ability to handle fossil fuel clients? And does that change? Does that delay anything, or is it just an added layer of complexity? But we'll get to where we need to be in good time.
If you're of our size and you operate all over the world, inevitably you get stakeholders on both sides of the argument. I think what I'd say is that I think we've been very consistent in our approach to this topic as a corporate. You know, we never subscribed to the kind of finance-centric view of the transition, which saw banks sitting as policemen telling our clients what they can and they can't do, dictating where you deploy and allocate capital. That is not our role. We don't have like a democratic mandate to do that. Our role is to enable the transition by providing access to advisory and finance for companies that need to go on that journey. Now, there were others who made that argument, I think particularly in the lead-in to COP26. I think there was some hubris around that at the time, but now realism and pragmatism reigns. And that's quite right, because the transition is not going to happen in isolation to societal change. And we have this trilemma as a society that we're trying to meet, which is how do you deliver energy security, affordability, and sustainability all at the same time? And the idea that banking institutions are the ones who are going to solve that problem is frankly absurd. And there were some who were suggesting that some years ago and have been proved wrong. That's always been our position. And we've always said, judge us, you know, by what we do and what we finance. And we set ourselves a goal that we wanted to achieve of financing and facilitating $1 trillion to help deliver against the transition. And that ran from 2021 and 2021, sorry, and goes to 2030. We've done, and this is until the end of 23. And since then we've done more, but up until that point, we've done more than $242 billion worth of financing against that goal. And that's what matters for me, not all the noise and the kind of loud voices on the extreme ends of the debate, but actually what are you doing to make a difference? And look, let's just be completely frank about this. In the short term, we do not have low carbon alternatives and renewables at scale, given the energy demand challenges I mentioned earlier, to do away with fossil fuels and go to some grand tomorrow. That's not going to happen. And so fossil fuels are going to be part of the energy mix in the short to medium term. The question is obviously, how do we get to somewhere different? And it's going to be through new technologies, many of which have been invented, but a lot of which are to be invented. That's not in our control. But what we can do is help fund those things and help market those corporates to investors.
What are European clients asking you about? What are they most anxious?
I think at the moment it's trying to make sense of the world and the uncertainty that there is. You know, when do you think rates are going to come down? What do you think is going to happen in and around the tariff situation? what about the supply chain issues we're seeing? Critical minerals and rare earths, is it really that big issue or not? And where if the world wants to go to a plan B and not rely on China, the DRC and Indonesia, where are you going to get the supplies otherwise? And production's one thing, processing is another. It's all those kinds of questions that we get asked. We have a specialized group within our investment banking business. I'm one of the leaders of it, our corporate advisory team, which has subject matter experts across all of these different verticals who are all bankers but also come from very different backgrounds, proxy advisory backgrounds, sustainability specialists, tax lawyers, all of that to help our clients make sense of all of these challenges and issues.
I mean, the rare earths issue is one of the biggest. I think yesterday we also had a story saying you leaders want China to really see how they can deliver on that ahead of the meeting next month. How do you see rare earths actually playing in this? It goes back to defense, it goes back to countries being self-sufficient, and it goes back to the green transition.
Well, that's the thing. I think these issues around the transition to a low-carbon economy and national security are just coming closer and closer together. And you have seen how this is played in international relations over time. In the 18th and the 19th century, this UK that we're sitting in had a very strong position, partly because we were the leaders in the first industrial revolution. We had loads of coal and iron, which helped underpin that position. And then you look to the 20th and 21st century with the emergence of powers in the Middle East, like Saudi, UAE, off the back of their oil supply. You now have a situation as we move to this fourth industrial revolution, or third, depending on where you take your figures. And China is leveraging its early investment into green technologies, not just for economic benefit, but for geopolitical advantage as well. And obviously played the fact that they control, 70% of the production of critical minerals, including rare earths, and 90% of the processing. They use that and export restrictions in the context of their trade negotiations with the US. I think we're going to see that more pronounced, how these issues play into geopolitics going forward. I also believe, I really don't think that the market has priced in the exposure of different corporates to these particular risks. Because although there isn't a supply issue at the moment, in spite of the growth in demand, you look at lithium, for example, there was a 30% increase in the demand for lithium last year relative to 10% over the 2010s. And we trade, lithium, cobalt, nickel, etc. But it's very concentrated amongst a few countries. And if there was a supply shock affecting just one of those countries, never mind if export restrictions were imposed by one of those countries, the implications for developed market companies can be very severe. And there is no doubt about it that certainly, the race to ensure that you have enough critical minerals in the context of this trade war, this poses an existential threat for some businesses, which, are some of the most well-known brands on the planet.
What's the solution? Because it also takes time. You can invest, but it takes, we're talking decades.
The US and the European countries are seeking to be self-sufficient and develop their own supply chains. But of course, that is unlikely to come without there being a cost, because, partly the prices are affordable at the moment. You don't have supply chain issues to a severe degree because it's relatively integrated. If you now move to different blocks being self-sufficient and it's fragmented and there's duplication across the supply chain, speaking to some of our strategists and people who trade these materials, there's a real risk that ends up driving cost up. And so, but that, I think you'll begin to see that reflected in prices once, the stockpiling that has happened depletes and the physical inventories of this stuff begins to reduce, and then you'll begin to see the price impact is what my colleagues who work on our commodities desk are telling us.
Chuka, when you look at the public-private partnerships, which everyone has been trying to get involved with, is sustainability or ESG further down the line, given all of the geopolitical tariffs, trade, even war concerns?
I don't think so, because ultimately, I think there is a consensus view and certainly if you look amongst governments and the politicians of left and right, that we need to transition to a low-carbon economy. And that's not just for sustainability reasons, it's for energy security reasons too. And although, I mean, the US administration is clear it wants to deregulate, I think here in Europe, it would be wrong to see the moves to simplify regulations and remove some of the duplication and red tape for business in the same vein. They're trying to simplify, not deregulate necessarily. And although, in the European elections last year, there was a move to the right, the kind of centre-right held. And so there hasn't been a big shift on that front yet. But I think the challenge for policymakers, given that in developed markets, middle and lower income families are living through a cost of living crisis, is how to transition without putting a disproportionate burden on those who are least equipped to shoulder it.
How do you look at AI? I mean, does it accelerate? I mean, it definitely accelerates.
Well, this is the big question, isn't it?
For green energy, but it also changes. I guess it could help at the margins, making it more efficient.
Yes.
If you have enough of it.
Yeah, so I haven't pinned my colours to the mast whether I think net AI will reduce energy consumption through the efficiencies or increase it. Personally, this is not necessarily a house view, I'm a progressive and therefore probably more inclined to optimism. So I'd like to think that AI ultimately net will reduce energy demand. But equally, I mean, I think Jamie's on the record on this, is that I think our view, which of course I've subscribed to, is this is going to be a evolutionary thing, not a kind of revolutionary thing that will change everything overnight. But is it going to affect, my children and their opportunities and the transition which is hopefully complete by then? It's always going to have a massive impact.
But will it accelerate? I mean, have you heard from leaders wanting to actually just become more green because we need so much more of the energy to just power AI?
Well, certainly if you look amongst the hyperscalers and many of the big tech companies, I mean, they need more energy and they're looking to low carbon sources for them.
Chuka, we have 1 minute left. What's the question you get asked the most, actually, in your role in sustainable solutions? Again, we started by saying there's hope because there are people like this in this room that want to make a difference. But what do they ask you apart from where's the money?
I think probably the number one question at the moment from corporates is trying to make sense of where the investment community is on the thematic.
Right.
And clearly in Europe, this is BAU, it's business as usual. It is not a controversial topic in the way that it can play in the US. And so trying to make sense of the noise to find the reality of the situation and how I should think about things is the number one question. And to be frank, I think if there are two benefits that have come from what has happened in the last year, one is it has anchored the debate around financial materiality. This was never charity. This was always going to be about making money, because ultimately these investors have to deliver a return for the asset owners and the beneficiaries. And I think this has anchored the discussion around that. This isn't some political endeavor or crusade. We see this as a big commercial opportunity, and that's ultimately where it's been anchored. And I think sometimes in the past, 3 or 4 years ago, there was a bit of a question of why am I actually being asked to do all of this by investors? And I think the second thing is a very interesting kind of observation I had in a meeting with the buy side, and I sit on the sell side, a couple of weeks ago, was one effect of, say, the withdrawal of some of these subsidies in IRA is you can see who can stand on their own 2 feet. You're not going to want to go and fund a company that cannot stand without subsidies and benefits. You want to be able to fund a company that's going to stand on its own 2 feet. And if you like, I'm not advocating for withdrawal of these subsidies and benefits. That's a political issue. But to the extent they get withdrawn, you see who's still standing, and therefore is obviously a more attractive investment proposition.
Chuka, Umunna, thank you so much for joining us this morning.
Thanks for having me. Thanks for listening, everybody. Thank you.
Thank you. Please welcome to the stage Dan McGrail, Interim CEO of Great British Energy, for a conversation with Bloomberg's Akshat Rathi.
Welcome to Bloomberg, and welcome to a live taping of the Zero podcast. The Labour government has big plans for GB Energy. It's been nearly a year since it was announced and created. You lead Great British Energy, and on 11th of June, under the spending review, you got an allocation of £5.8 billion. Great British Energy Nuclear, which is a separate entity with a separate governance, got £2.5 billion. So let's focus on the bit you run.
Yeah.
And give us the big picture. Say in 2035, 10 years from now, what do you hope GB Energy will have achieved?
Well, first of all, thank you for having me here, and good morning, everybody. Look, Great British Energy is an innovation from a policy perspective, which, from my point of view, and starting really at the sort of the big picture and the motivation, is I think it's fundamentally a good idea to give British people a stake in the energy transition. I mean, we're here today because we see this as being one of the great economic opportunities of our times. And I think it is right, therefore, that we find ways to, create a dividend for British people. And I think that's a motivation in and of itself. But as an energy industry professional, and having worked in the sector pretty much all my career, I actually think there's a discrete role for a state actor. Because, the private sector has been incredibly effective at mobilizing and I think Chuka was just talking about the role of subsidies. It's been very effective where we've had sort of policy and political stability, wider economic stability, and things like the growth of offshore wind were possible partly because the conditions were quite benign. Mm-hmm. Whereas we look today, the world is more complex, and yet we have a series of mature technologies, and as we strive to achieve that energy security, independence, and abundance, we have a series of mature technologies which we know the private sector can mobilize. But there are some frontier technologies which we know we're going to need, which by 2035 need to become pretty mainstream, where private sector activity is comparatively low at the moment.
Right.
So we see a role for GB Energy to invest alongside the private sector to really target areas where there's a nascency in the technology. Obviously, we believe in the trajectory. So it's not speculative, it's fundamental, and we can talk about some of the examples. But the role that we can play to catalyse investment, to bring that additional confidence that, look, the UK government and as a country, we believe in the role of these technologies, and therefore we build our capability and our strategy around them.
So let's talk about specific technologies. You've said GB Energy is the first publicly owned company in 75 years, and you're very proud of being able to give it a shape and ability to do something. Now, £5.8 billion, a big sum, but let's put it in perspective. The clean energy mission, which is supposed to get the UK to 95% clean power by 2030, is going to be needing £200 billion in investment. Yeah. So how exactly do you plan to invest or spend this £5.8 billion for maximum impact?
So it's a really good point, because it is a large sum of money, and bear in mind this is a sum of money to start the organisation up, right? So our aspiration by 2035 is to start to build towards the scale of other comparable state-owned energy companies such as Ørsted or Vattenfall. So this is the sort of endowment that gets us moving. But you're right, we have to invest intelligently, and we know the cost of one offshore wind farm or a major investment is already in similar numbers. So we have to initially invest in sort of the spaces where we really think that can have maximum value. So I'll give you a couple of examples. We know by 2030, pretty much every offshore wind farm in the UK is going to have to be in water which is deeper than 80 metres. Now, that's quite a technical point, but basically what it means is that those wind farms are going to have to float, right? Which is, is an area of investment which is, at the moment, quite challenging. There's a significant amount of private sector capital deployed, but it's slowing down in its progress. So we're going to look to come in at that riskier stage of projects in their development phase, so prior to the major investment decisions, when we do expect private capital to come in, and we may deploy some of our capital as a minority partner, but ultimately to send a signal to the wider investment community that the UK government believes in the trajectory of these technologies, and we will believe in the long run, because it takes 4 or 5 years to get to the investment decision. So bridging that risky gap where you've got to go through consenting, where you've got to secure the grid connections, where you've got to go through that whole development at risk, that's a space where we think we can deploy, sums of capital which are meaningful, but then get you to the point where you can crowd in the private capital.
So what you're mentioning there is floating offshore, where you don't have these wind turbines actually tethered to the floor with a big concrete base, which is what current offshore tends to be. And the UK has a good track record in taking a frontier energy technology and then lowering its price. But the UK doesn't have a good track record on building businesses around those technologies. So there is no British company that's going around the world building offshore wind farms today.
I dispute that. I think there are some, SSE, for example.
Yeah, but they're not doing it at the scale that an Ørsted is doing, or Vattenfall, the two examples that you brought up, right? But Ørsted does that.
Yeah.
How exactly do you think with £5.8 billion could you create an industry or a set of companies, or maybe one big champion that would do floating offshore, not just in the UK, but globally?
Well, clearly we've got to work on how we target the investment around partners who we really believe can create that scale, and whether we can be part of that in terms of building capability and experience over time. But the other part and the important narrative around GB Energy is the role that we will play in co-investing in supply chains as well. Because ultimately, we've chosen to locate in Aberdeen for a reason. There is a really, really accomplished oil and gas supply chain, which is specialising in, amongst other things, everything that happens below the waterline. I'm here talking specifically about floating offshore wind here. There is no offshore wind farm that's been built in the UK that hasn't had a role for some Aberdeen supply chain as part of it. So we think there's a role to build UK domestic champions in the technology that helps scale. And it isn't just isolated to wind. It's also, we can go beyond that and look at carbon capture and storage, or long duration energy storage, things that we know we're going to need in the future, but right now require some of that seed capital and that confidence in the projects to build future.
So on 23rd of June, there was an additional announcement saying, at least in the press release, it said the government is announcing additional £700 million going to GB Energy for building up these supply chains. Is that new money? Is that additional money beyond the 5.8 billion?
It's part of our overall budget, but that we're allocating specifically towards supply chains.
And can you give me an idea of how exactly do you invest in creating that supply chain, like specific examples?
So part of it will be in the traditional way of supporting it with grants, and that will be a part of our business, which frankly is non-commercial. And then we also look to take equity positions. We'll work also with partners like the National Wealth Fund to look at how we can invest in companies that we believe in their technology, believe in their trajectory, and then support that with the pipeline of projects so that their technologies get deployed.
In this audience, you're going to have many investors, many banks. How have your conversations with those entities gone? Because you're going to have to co-invest with them, given you want to multiply the sum that you have been allocated.
Look, I've just come from a meeting this morning with a major, well-known UK bank and their sustainability practice, and genuinely, this is one of the things that's really heartening for me, is that the inbound inquiries into GB Energy, the amount of people who are bringing us opportunities, is kind of proving that the fact that the market wants, and the role of this kind of long-termist, maybe greater risk appetite player in the market to work alongside the private sector. So look, I'm encouraged by the quality of the conversations, the breadth of the conversations that we're having with banks, with institutional investors, and ultimately with developers as well.
One thing we didn't talk about in the technology set is about 30% of UK's emissions come from burning gas in homes, home heating.
Yeah.
Is GB Energy going to look at decarbonizing heat, and how?
At the moment, look, our priority is probably around power, right, and electrification. And we're, over the next 3 to 4 months, we're going to be working and quite consultatively with the sector on understanding how we develop a long-term strategy. I mean, the last question to Chuka there was, what question do you get asked most? The biggest, most frequent question I get asked is, what's GB Energy going to do, right? And I need to answer that question in fairly short order. So, our intention is to be really, precise on where are the areas of technology that we're going to invest in. And I'd say another point on this, which is, look, if you look at those other European publicly owned energy companies like Ørsted and Vattenfall that have been set up, they all set up with a technology strategy around them. So, Vattenfall and Statkraft were hydro companies, Ørsted offshore wind, EDF nuclear, so on and so forth. So we need to, I think, create capability around certain technology fields. And right now, heat, we see ourselves as in the kind of business-to-business space. Heat is very much in the consumer space. That said, we do see scope for community and local energy within our strategy. It's certainly something that the government envisages being part of the strategy. And there will therefore be an intersection with the electrification of heat. And so we have to explore exactly how that might work in practice.
So it'll be your anniversary of creation on 5th of July in 2025. But in that period, what exactly have you built? There's one project announcement that I've seen around getting rooftop solar for schools and for hospitals. Mm-hmm. What else?
So to be precise, the anniversary of the government is on the 5th of July. That's right. We actually got royal assent. I can't remember exactly the date, but it was something like the 11th of May. So our legal existence is a matter of weeks rather than a year. Having said that, it's not like we've been doing nothing. So we've been building the organisation up, recruiting people, which is an important place to start, and also prioritising some early activities. So one of you referenced the rooftop solar scheme, and this is an area where we're really looking to learn and build capability. So we've chosen to invest part of our budget into investing in around 200 schools and hospitals, rooftop solar schemes. And the effect of these is really interesting, because we went to visit one hospital in Hull, which had built a 5 megawatt array on a field that it just had next to the hospital. And they're fortunate enough to have the capital available to do it. But it's saving them about just under £2 million a year, which funds about 50 Band 5 nurses or 30 fully qualified doctors. So it's an outcome. It's using energy and sustainability as a vehicle to achieve a better outcome. And equally, I went to a school in Sheffield, right in the middle of a pretty deprived area, where they were able to fund teaching assistants and so you're improving educational outcomes, and they're engaging the kids in it. So this is a really logical thing that we should do more of. Now, these first investments really help us learn and see what the scope and the potential of this is, but we see the local aspect of how we can use public sector real estate as effectively an anchor tenant to build smart local energy networks as a business model that can be scaled and can be outcome focused, as well as just being about purely electricity.
And you said the word invest, but my understanding is this is grant money.
This is initial grant money, but it's the long-term runway for this is how do we turn this into a business?
And what of the £5.8 billion will be roughly grants, and what will be invested in companies?
We're about £1 billion in grants altogether, albeit we will work intelligently with the business community to see whether actually where is the grant the right solution, where actually equity could be a better solution. So we'll try and have a degree of flexibility in how we approach that.
Another thing that we haven't talked about is transmission. Now, in the £700 million announcement on supply chain building, there was a mention that transmission would be included in that spending. Transmission is a key bottleneck for electrification in the UK. There's too much wind in Scotland and there's much more demand in the south, the Clean Energy Mission and the department have a plan to try and build more transmission cables going up and down. How exactly does GB Energy take part in this? Is it in just traditional investments, or is it advanced technologies? Because there are quite some very interesting ideas for taking the same cable and sending 3 times the amount of power in them, for example.
I think the short answer is both. I mean, I think we have to act in the short term to alleviate capacity in the market and build capacity, and it's actually part of our sort of energy independence narrative, because look, the reality at the moment is that people building wind farms or transmission networks are competing with transmission operators in other markets for factory slots. And interestingly, I don't think it's just about factory capacity, it's also about skills capacity. I mean, electrical technology is probably the most complex part of the value chain in terms of understanding and building capability. And so we've got to work actually quite coherently here in terms of, on one hand, building out capacity in the short term, building skills that can act alongside that, and we won't do it on that that on our own, because there's a big ecosystem of actors around building skills. But in the long run, when I think what's going to ground capacity here in the UK for 20, 30, 50 years, it's going to be innovation. We don't, if you look at the aerospace industry has, we make wings, we make landing gear, we make avionics, and so on and so forth, and propulsion systems in the UK, because we have the best innovation ecosystem that drives that. It's not because we're a low-cost country or we buy more planes than anyone else. We just have to build deep capability. So for me, it's really important that when you're looking to add manufacturing, you add that manufacturing as part of an ecosystem, which is, or an innovation pathway, which is then becomes self-sustaining.
So we've talked about the idea that GB Energy could try and unlock more private capital, could try and advance some of the frontier technologies. But one driving principle that this government has been trying to work on is to lower the cost of energy.
Yeah.
How exactly does GB Energy satisfy that need?
Well, I've always believed from the beginning that lowering energy costs is a national endeavour. It's not, you can't sort of delegate that responsibility to one organisation. So the role I think we can play, partly we've talked about already, which is about crowding in the private capital. I mean, ultimately, the private capital, the more we crowd that in, it will bring more competition, it will bring more availability. But it also, I think, the other area that then is helping to alleviate capacity constraints in the supply chain. And then the third area where I see us playing a role is doing more to build these really sort of potentially transformative smart local energy systems, where we bring at the moment the limit to those being built out further is much more about capital availability and the business models and the bankability. It's not about technology, it's not about innovation, it's just about how do we turn this into a model which makes it accessible to more social housing providers, more local authorities, more hospitals. So we might not necessarily be there focused on the overall system, but it'll be about how do we bring targeted benefits to the communities within which we can work. And ideally, that is a scalable thing which we focus on those that need it most in the first instance.
So we started the conversation by talking about, let's lay out what would be specific achievements that you think GB Energy will have in 2035. Now, we've gone through sort of the ideas that you have, but let me come back to that question, because you didn't paint a specific enough set of achievements that you would hope. And I'm not saying you know what will happen, but if you were to dream, what would be the 2035 achievements that you'd be proud of?
Look, I mean, let me start with the local angle, because we just talked about it. I would like to see, right the way across the country, smart systems where we're integrating solar on schools or on private businesses or on local authority land, together with battery storage and maybe some EV charging. We've got a big challenge in bringing EVs to people who don't have off-street parking, for example. So how do we bring those things together, turn them into business models which ultimately allow people to get access to that at sensible prices, and sort of democratize the electrification of of society to as many people as possible. So that I would like to see Great British Energy's logo on hospitals and schools right the way across the country, and other local community organisations. I would like to see us invested in these frontier technologies that we know that we need. I'd like to see floating offshore wind farms spinning in the North Sea with supply chains behind them, thriving in the northeast of Scotland and Aberdeen, where we've helped alleviate the impact of transition and make sure that creates jobs and opportunities for people who may be affected by the decline of some other industries. And I'd like to have some really smart British companies exporting their know-how, and maybe GB Energy is part of that ecosystem, exporting that know-how to other countries, and whether that's in long duration storage or carbon capture and storage, I think the scope for that, 10 years, that's my mission.
Now, the initial announcement when it was made was GB Energy will have £8.3 billion. You've had to give up 2.5 billion of that to GB Energy Nuclear. Does that undermine your ability to live up to this dream?
Yeah, to turn that into a negative, I mean, ultimately, the founding statement was very clear that there would be, there'd be a joint element of it. But look, we're starting the company up. We secured £6 billion. That is a lot over 4 years to catalyse a company. So I don't, I see that budget as a huge, actually a challenge to think, how do we deploy that intelligently and maximise the impact and the return, whether that's on jobs, on growth, on returns. That's a huge opportunity for us, and I certainly don't see it as an inhibitor, put it that way.
So last question for you, perhaps the most difficult one. Your title has interim CEO in it. GB Energy, the government created it on 5th July 2024. You say the legal entity didn't exist until May, but you've been interim CEO since March. For energy companies, there should be no shortage of applicants wanting the job of a CEO, wanting to build a vision that you've just painted. Why is it taking so long to get a full-time CEO?
Why is it taking so long? Look, I mean, interim came in because about speed. Actually, it was about wanting to stand the company up quickly. And I work in the industry, and I'm incredibly enthusiastic about this. So to be asked to come and go on loan, as it were, to do this was a huge privilege. And then, to be honest, the really important point is that when you go through these appointments in the public sector, there has to be a thorough process. And that process, for anyone who's ever worked for the government, will probably understand that process is not something that you can do overnight. So it takes time, but it's I think it should be clear soon. Put it that way.
Thank you, Dan.
Thank you very much indeed.
Please welcome to the stage Lori Layburn, Executive Director of the Strategic Climate Risks Initiative, and Sherry Madera, CEO of CDP, for a conversation with Bloomberg's Olivia Rudgard.
Great. Fantastic. Well, it's lovely to be here. Welcome. I think this is it's an interesting sort of timely conversation about climate goals and goal setting in the corporate world. We're at quite an interesting moment, I think, both in terms of climate and in terms of sort of corporate ambition. We're in a very different place since a lot of targets were made a decade ago. And at the same time, we have quite a lot of evidence that climate change is moving very quickly. We're potentially at 1.5 degrees in the last few months. which doesn't necessarily mean that we've sort of blown past that Paris target, but it does mean that it's looking sort of dicey as to our abilities to meet it. So I think it's quite an interesting moment to talk about corporate ambitions. So, and we've had some quite high-profile announcements from companies recently that they're sort of not going to. Walmart is one example. Companies that are saying they're not going to reach their targets. So, Sherry, I mean, this is your business. You talk to companies about their climate ambitions. I mean, have companies given up on this, do you think?
Well, first, thank you very much for having this discussion. It's a really important one because we get to build in data to what we're thinking as opposed to actually just picking up sound bites. What we're seeing is that companies are maintaining or increasing their climate ambitions. And again, you know, we can say this from a position of having 2/3 of the world's market capitalization reporting through CDP, over 25,000 companies last year, and we have 1,100 cities, states, and regions, which also encourage the companies that are in their jurisdictions to disclose. So 50% maintained, 40% raised their ambitions. And since we're sitting here in London during London Climate Action Week, let's think about what's happening in the markets here. So FTSE, 93% of the FTSE disclosed through CDP. And what we're seeing is that only 4% amended their targets. Of that, only 2% amended them down. So we are actually seeing that the numbers are not bearing out the trend that says that they're ditching their targets. Actually, last week we opened our cycle. So now, you know, as of last week, we're getting new data in. And what we're seeing is a over 25% increase in companies at this time in the cycle, 1 week in, that is 25% up on last year in terms of companies that are engaging with the disclosure process.
Interesting. Okay, so there's something that sort of goes against the kind of prevailing narrative a little bit there. Laurie, to bring you in, I mean, 1.5 aligned has been a very significant way for companies to define their targets. Why is that an important way? Why has that been an important way to think about climate targets? And do you think it's still a useful way to define them?
So we have the 1.5 target, not necessarily because it is a definitive threshold in how the Earth system behaves, but it's as good as we can get as an approximation of where we would see a major escalation in the risk that is then created in the Earth system. That includes everything from the worsening heat extremes that we're seeing and experiencing, through to the potential for major shocks to food systems, all the way to these climate tipping points that we hear more and more about in the news at the moment. So 1.5 is a good rule of thumb for limiting that risk in the Earth system. Now, we are going to go over it. We will break the Paris goal at some point in the next few years. That will definitively be broken. The latest World Meteorological Organization data infers that this definitive break is probably going to happen by, let's say, around 2028. So we are going to go further into that risk zone. What that means for when it comes to a target is that we will need to ideally still reference back to 1.5 as an anchoring point. How that is done is very difficult because it will require a huge amount of things. One is cleaning up the mess, drawing carbon back out from the atmosphere. That is the thing we need to do to restabilize the Earth system, as well as then becoming more resilient to deal with the consequences of entering that risk zone.
Okay, and we actually have a poll, by the way, which is going to ask all of you what your companies are doing on this, whether ESG is still something that you're talking about a lot. There's also been some discussion of green hushing, so this quieting idea. I mean, why do you think the companies that you talk to are still doing this with everything that Laurie says in mind? You know, why is it something that is still a priority based on what you're seeing?
Well, I have the luxury of talking to many companies, C-suites about exactly this, Olivia. And what I am hearing consistently is that there has been a strategic commitment in terms of not their emissions, but their business. So they have, you know, companies have already embedded some of this, you know, tracking, tracing targets into how it is that they're planning their business going forward. And we're seeing that bear out in the numbers as well. So often people think about CDP as collecting greenhouse gas emissions data or water usage or thinking about waste, et cetera. But especially over the last 5 to 6 years, we've been looking at what are the opportunities? You know, how is it that a company can look at not only the risks, which are obviously significant and should be analyzed, but what are the opportunities? And this year, we've seen $12.8 trillion worth of opportunities coming out of the survey. And that is all down to, how is it that we can change our supply chain? How can we lower costs in terms of producing what we already have? How can we integrate lower energy costs across our entire value chain? Also, how can we innovate new products that are going to lean into a sustainable future? And so those are already in train. So part of that is what I'm hearing, which is actually all of that is good business sense. We're talking about resilience. We're talking about great new opportunities. And that's not woke. That's not something about sort of pulling sustainability out and putting it on the sidelines. It's actually already embedded.
But at the same time, I mean, there's a lot of public pressure, especially if you have US operations, the political momentum behind this has very much shifted. It's also shifted to some extent on the investor side. Is that impacting the way that those C-suite executives are sort of thinking about this, that kind of external pressure?
Yeah, those conversations I've been having, and I just referenced, the door was closed. Right? The door was closed. I think that what we're sensing is that the commitment to continuing to surface data, think about how it is used for business, both mitigating risk and looking at opportunities, that's still there. I don't think companies have the appetite to talk about it as much. And actually, in some ways, that's okay. As long as actually what we're talking about is that sustainable business is good business, we can drop the word sustainable. Maybe we're at that pivot point. But I think one of the things that we all do need to commit to is the fact that if you don't have the data to start tracking how it is that you are meeting those business goals, where is the resilience, where is the risk and opportunity, how are physical risks changing what it is you do and where you do it, that is actually what we should be starting to focus on, as opposed to perhaps a story, a nomenclature, a narrative that may not be fit for purpose today.
That's interesting, and you can see that we have some data here showing how mentions of sustainability-related terms have shifted. You can see the dynamic there with the US being, there's a fall across the board, but the US is a much more dramatic fall, which I think maybe is a reflection of that sort of differing political environment. I mean, Laurie, would you agree that sort of talking about it less is not that much of an issue, or do you think companies still need to be talking about this?
It depends the domain, it depends the sector, it depends the political context that one particular company is in. I mean, I'm looking at this right now, the graph that we got up on the screen behind us, and I can imagine a similar trend where we don't talk in the first instance about climate continuing. We're seeing it at the moment partly with moves towards renewable energy being an energy security priority for governments, and companies are playing a role in that as well. Into the future, we could see a situation where as physical risks manifest in a way that we don't anticipate, because many of our economic models are very limited in including all of the risks that are building up right now, which gives us a false and benign impression. As that starts to play out, some of the investment opportunities might be ones that support the reduction of emissions, but in the first instance are about a wider range of security issues, not just energy, but the things we need to ensure that societies remain stable and prosperous, even as they are experiencing a world in which we're not just got more weather extremes, but we have more of the cascading consequences. And it is those domino effects, the kind of domino effects we became used to in the context of COVID-19, the energy shock since then, that are really going to characterize what comes next as we head deeper into that 1.5 risk zone. So you can imagine company reporting, talking about investment opportunities that they're going into that, sure, are going to reduce emissions, but because some of those things that are needed to reduce emissions are also those things that can keep societies safer and more stable in a much more dramatically climate-changed world.
Mm-hmm. And we were just talking about the US. I mean, when we're talking about risk, it's not just about sort of physical risk, climatological risk, there's policy risk and political risk as well. I mean, is that something that you think companies should be, are they taking that into account, or should they be taking that into account more when they're sort of setting these targets in the way that they think and talk about climate?
I think that yes, they have, particularly in looking at things like transition risk. There's obviously been a lot of focus on that, how we could see rapid changes in policy, and that could affect business operations and profitability. Into the future, we could get weirder and more unexpected types of political dynamics. We can observe one of those dynamics occurring over the last 6 or so months. Let's take Valencia, the unprecedented floods that happened there. you might expect that in the wake of those, we would see a surge toward political support for climate action in response to disaster that was partly driven by climatic factors. But we saw the opposite. We saw a paradoxical situation where the far-right party in Spain was able to capitalize on that event to exploit the anger and dislocation that came from it. We're particularly concerned at the Strategic Climate Risk Initiative that this dynamic, which we call derailment risk, the idea that the worsening consequences of climate change could begin to create conditions that frustrate our ability to deal with the causes of climate change, that type of vicious cycle dynamic could be one of the more unexpected political consequences going forward, because we are entering a much more weird and a much more uncertain world.
Is that reflected in your conversations as well? Is that something that, I mean, our question is, does climate need a new North Star? And we've talked about all of the other things that are not just kind of carbon cutting, but is that something, this sort of derailment risk and all of the cascading things that happen as we start to see the actual physical effects of climate change, are corporations starting to bring that into the conversation more as well?
Yeah, I mean, I think that there's definitely a shift happening, and I'd like to reference two different things. One is we did some research earlier this year together with the World Economic Forum and Oliver Wyman, and one of them was to look at market capitalization. So in terms of climate leaders versus laggards over the course of the last 5 years, and of course, because we have the data density in terms of the reporters, we're able to start thinking about this. And what we found was that across all sectors and across all geographies, it was the same sort of market cap increase for the leaders and the laggards. And we took those two groups and looked. Well, that's not very inspiring, is it? So let's look a little bit further. And what came out of that was that if you look at transport, you actually get a 10 to 12% bump in your market cap because you are a leader versus a laggard. Guess what happens in energy? In energy, it's the flip of that. So the laggards are getting rewarded by 10 to 12% versus the leaders. That's something we should be talking about. That's something we should be thinking about and considering how does that, because that plays into the decisions that are being made by some of the most hardest to abate sectors, the energy sector, the material sectors, et cetera. So I think that there's something there. And I also think that there's something about, actually, that's grounded in today. No one is going to be able to go through a whole week of their life these days without saying AI or hearing AI. And so what is that all about? That's all about jobs, growth, potential, excitement, innovation. Well, AI is a huge suck on energy and on water. So if we aren't actually thinking about how is it the new growth trend is going to affect some of the commitments that these sustainable businesses are making, not just in tech, but in all walks of the society and sectors, this actually could be something that derails perhaps some of the great work that's been going forward. And it doesn't have to. We just need to think about how we're conscious of that and really actually lean into what's happening today.
Yeah, and I think that dynamic around energy is really interesting. That's a very interesting stat, and you can maybe see that in the real world with what's happened with BP, and they've not necessarily been rewarded for moving perhaps a bit more quickly than their competitors in the renewable energy direction. I mean, do you think that that kind of dynamic shows the limitations of corporate climate action as well? I mean, they are operating within an environment that they often can't directly control in terms of sort of regulation and technology development. Do you think that there's that sort of shows that there's other things that need to happen in order for this to be a sort of meaningful and helpful contribution to climate action?
Yes, into the future, when we do see some of the things, very unexpected and serious things happening, it will, state intervention is going to what's going to be needed, right? We can't really shy away from that. That's not I maybe sound negative in saying that, but we're just into a new climate reality now. That is the symbolism of us exceeding the 1.5 degree goal, and it will require, it will lead to more emergency situations, and it will require more emergency responses. We don't necessarily know what they will be. And at the moment, I think if I was in the private sector, one thing that I would be particularly concerned about is that I was not getting enough direction, say, from regulators about how I should be doing some of my climate risk assessment. Because I personally am very concerned about some firms that are using third-party consultants and risk assessments that are giving them a pretty benign idea of what it is going to be like as we head over 1.5 degrees. We can't be in a situation at this late stage where some pension funds have climate risk disclosures that tell them that in a 4-degree scenario, we will see a 1% drop in asset allocation. That does not conform to what the science is telling us about the instabilities and risks that come from the Earth system. Now, what that means going forward is that we need to improve those. Like a ship needs a very good radar when it enters a storm, because we are globally now in that storm. It doesn't mean the game is up. When a ship enters a storm, it doesn't just suddenly sink. It means you're in a much more volatile world. We already know we're in that for other factors like geopolitical risk and interstate conflict and so on. But as the climate element of that really begins to bear, we need very, very good situational awareness. And at the moment, my concern that as we enter that storm, it doesn't look very good in some domains. That ultimately isn't necessarily the fault or the major responsibility of an individual firm. There, I think, needs to be regulation or direction from regulators to say, okay, we are now in a much riskier and less certain world when it comes to the climate. Here are some standards about how the markets for risk assessment need to work, certain scenarios you might all want to look at. We need some of that direction, I think, from regulation to help firms develop that type of situational awareness capability in this storm.
Okay, interesting. And I mean, ultimately, these businesses are sort of motivated by, a lot of businesses will have to think about their shareholders, they'll have to think about their bottom line. How are those kinds of conversations changing within companies? You know, on the sustainability side, are those people able to persuade, you know, the people who look after the money that this is something that's worth doing, that this is something that is not just going to be a suck or a drag on finances? Is that conversation shifting at all?
Yeah, and I'm going to unapologetically come at this from a disclosure angle. So why do companies disclose? This is not free. This actually takes a lot of investment, a lot of time, and a lot of focus. And so they do so for 3 reasons. One is access to capital, being part of universes and being able to actually disclose to investors. The second one is business efficiencies, and that includes that your customer is asking you. In fact, that is the most compelling reason why companies disclose, because their customers are asking. And the third is compliance, and this perhaps takes a page from Laurie's book as well. Compliance and policy are driving why companies disclose and why companies are taking actions and making business decisions. So if we look at that, those 3 things together, all of those stakeholders are actually weighing into a business's decision, not only to find the data that they need and where is it they're tracking, how do they set targets, how do they create transition plans. And actually, if we ladder that C, that compliance, up into policy, really actually what we should be calling for is a whole of economy approach. Not just to go to COP30 in a few months' time and talk about NDCs. It's about how does that actually really relate to the businesses that are going on within that jurisdiction, and actually thinking about how you can actually create a meaningful relationship between those policymakers, that clear a direction of travel, and the businesses who are committing to continue their FDI, their jobs, their growth in that jurisdiction. I think if we have that partnership, then we are actually moving forward in a way that isn't isolating or creating any regulatory arbitrage or worries about compliance and where is it that we need to do that. This data set then starts becoming useful for all of those use cases, your investor, your business, your customer, and your regulator and your government. I think that that's where we need to start thinking in a bigger picture.
Interesting, yeah, and that kind of global environment is also quite challenging, I imagine, because you might have one jurisdiction who's doing that, and then another jurisdiction who's doing sort of exactly the opposite. Speaking purely hypothetically, obviously. So how do you kind of square that circle? Like, if you're a company that has a leg in both places, perhaps, like, how do you manage, those very competing priorities?
Well, if I can have a quick go, and then Laurie, you can probably shed some more light. I also think that we're talking not only about climate and carbon anymore. We're talking about a whole Earth approach, or a whole, how is it that we have nature involved? We haven't talked about that yet, but what we're seeing is a clear increase in the demand for data on water, on forests, on land use, on biodiversity. And these things are not because we're actually extending we would like to do good. It's because these are true inputs into the economy. I think that that's where actually businesses are in very solid ground. And that is where they can actually speak up very clearly. If you have water scarcity issues, if you have a prediction that the land is going to not be able to deliver what you need for products, that is a very clear economic discussion to have. Actually, I think we should welcome that into perhaps that is what's going to lead our way into thinking about how that affects the entire ecosystem and how it is that we can do better with that.
Interesting. And I don't know if we have results from the poll that we did earlier on to see what's actually how that's manifesting in with our audience. Laurie, do you have any thoughts on that sort of diverging regulatory environment?
Well, I would more underline what Sherry was saying about how bundling in, or what might to some feel like bundling in nature and other environmental factors is absolutely the right thing to be doing. Looking just at the climate element of the problem that we face is way too narrow. This is an Earth system crisis. It has always been an Earth system crisis. The planet, similar to a human body, has various interacting systems. A climate is only one part of the overall planetary body, as it were. And making sure that we understand the risks that are being created in the other individual components, in the water cycle, in the biosphere, and so on and so forth, is critical to understanding the overall health of that planetary body. So really, from day one, they should always have been bundled in together when you look from the perspective of risk. Because even if tomorrow, suddenly, all emissions stopped, the temperature rise slowed down and no longer continued its onward march, we would still be facing severe crises in those other systems as well. So this is the rational response, globally at least, in the aggregate, to trying to calm those overall risks in the Earth system.
Interesting, great. Well, I think that's the end of our time. Thank you so much. It's been very, very interesting to talk to both of you. Thank you, everyone.
Please welcome to the stage Eric Kane, Director of ESG Research at Bloomberg Intelligence.
Hello, good morning, everyone. Thank you so much to the Sustainable Business Summit team for including me today. As the voice of God mentioned, my name is Eric Kane. I'm the Director of ESG Research for Bloomberg Intelligence. And today I want to talk about some recent research that we've introduced that looks at how ESG events drive stock prices and credit spreads. So that'll be the bulk of the conversation. I do want to provide a brief introduction to Bloomberg Intelligence, or BI as we call it, talk about some of the other research that we've done historically to answer this pivotal question about how ultimately we link ESG to financial performance. Then we'll really spend most of the time on the market-moving news research that we've introduced, and then finish with some next steps and some key conclusions, I think. So for those who may be less familiar with Bloomberg Intelligence, or again, BI as we call it, we're one of 3 research arms here within Bloomberg. We have about 500 analysts globally covering over 2,000 companies from a variety of perspectives. So equity, credit, policy, litigation, and of course, ESG, where I come. So when we think about the ESG team within Bloomberg Intelligence, our focus is really, really strict on financial materiality, right? So it's our understanding, of course, that there are a number of issues that are financially immaterial to different industries, and it's our mandate to ultimately help our clients understand what these issues are, how they're impacting businesses, how they're impacting industries. So on this slide, we have a variety of different kind of research and data areas that we focus on, including a lot, of course, on climate and transition, including BI Carbon Forecast, where we look at the most carbon-intensive companies, about 500 of them, forecast their emissions out to the years 2030, compared to a temperature-aligned benchmark, et cetera. And just skipping down, we've also worked very closely with our partners across the organization to help build Bloomberg's ESG scores and gender equality scores as well. So for the bulk of the presentation, some key takeaways. I think traditionally when we think about answering this question about the link between ESG and financial performance, the focus has historically been on backtests, right? Looking at a specific metric or looking at a score and using that to ultimately look back in time and see how that corresponds to key financial metrics, whether it be total returns, drawdown risk, et cetera. And that is absolutely key. And we continue to produce examples of that research, and I'll actually go through a couple in a minute. But I think in this moment where this question about the link between ESG and value is even more prominent now than ever, we need to introduce new pieces to the puzzle, ultimately, right? And that's where our Market Moving News app comes in, where we really answer a critical component of the question, which is, it's one thing to understand how backwards-looking data may correspond to performance, but what happens when an ESG event is going to take place, be it an oil spill or a product recall? How does this actually impact stock price? How does this impact credit spreads? And that's really the bulk of the work that we're doing on the Market Moving News research. And what we'll ultimately see is these responses vary. They're just not always intuitive, so it varies not only by asset class, but also by region. So I mentioned kind of the traditional backtest work that we do. I want to go through just a couple examples quickly. Climate Alpha is one of them. So the idea behind this research is really to look at carbon-intensive industries like oil and gas, steel, cement, airlines, et cetera, to understand what the key climate metric there is in terms of efficiency, and then to see if that ultimately yields an alpha signal or not, right? So on this slide, the example we're looking at is oil and gas producers. We're looking at a global peer set here, and we're essentially looking at top performers on methane efficiency. So those companies that ultimately produce oil and gas more methane efficiently, we're comparing those to the peers who produce it less efficiently. And what we see across the board is that the top 25% in terms of methane efficiency are ultimately outperforming the laggards, the bottom 25%, by about 29% over the last year and about 13% annually over the last 5 years, and that's total returns. Right, so very strong signal for those of us who follow this space. We know, of course, that methane is one of the biggest concerns when it comes to addressing climate, right? So if we can think about how ultimately that could be integrated into an investment portfolio, there's tremendous impact for value creation, but also for addressing the emissions associated with your portfolio. Another key backtest that we look at is our ESG Alpha, and this really uses the ESG scores that we've been to ultimately look back in time, all the way back to 2017, to understand where across all the industries that we've scored, over 106 industries, where there's a very distinct correlation between performance on an ESG score or a sub-issue and things like total returns or lower drawdown risks. And on this slide, we have a couple key examples, but the examples are numerous across different industries. But here we're looking at health and safety in materials. So materials, of course, includes industries like chemicals, metals and mining, et cetera. And what we see here is that companies that do better on health and safety metrics outperform those who don't. We look at a top half versus bottom half by about 4%, just under 4% annually for chemicals, and over 4% annually for metals and mining. Right? So again, a very clear indication that there's a link between performance on an ESG metric, which is of course financially material to chemicals and mining, and outperformance, which we articulate here. So that's a little bit of kind of the history. Now we move into the more recent research that we've introduced to help kind of add another piece to the puzzle. And this is our Market Moving News research. So what we did here is we decided to leverage the myriad of tools that we, of course, have here at Bloomberg, and we looked back at 9 years of news data. We used news codes, which are embedded in every story, to identify when ESG events happen, right? So this is an industry-specific lens, so we'll go into it in a minute, but if we're looking at oil and gas, we're looking for events that are specific to that industry, things like oil spills, things like labor strikes, things like fatalities, right? We're looking to identify those issues. We're scrubbing the data. We're making sure we're not looking at duplicates. We're only looking at stories that are high confidence. And then we're also looking to see whether there's a correlation between that event and subsequent changes in either stock price or credit spread. And we'll go through a couple of examples of each. For stock return specifically, we're looking at 1 day after the event. We're looking at 7 days after the event. And of course, it's crucial to ultimately compare to different benchmarks because we don't want to accidentally account for some other thing that may have moved the market significantly that day. So when it comes to stock prices, we're ultimately looking at a global benchmark, a regional benchmark, and then an industry-specific benchmark. Credit is a little bit different, where our universe is defined by those who ultimately have, at the time of the event, a dollar-denominated bond that is a 5-year bond between, so basically looking at maturities of 4 to 6 years. And then instead of comparing to a benchmark, we're looking at that relative to the government curve. So let's get into some of the results here. So on this slide, pardon the silly title, this is one of my favorite parts of my job, is coming up with cheesy little titles like this. So drilling deeper into oil and gas, pun intended for sure. What we see here is ultimately the frequency of events and the average impact on stock price. So what we see is events like strikes, pay disputes, ultimately occurred most frequently during this time period, and oil spills was the second most frequent. And we also see for both types of events, on average, these contributed to negative impacts on stock price. So just to put some numbers around that, when we look at spills, for example, over a 7-day period, companies that had those spills ultimately saw their stock price or total returns go down by about 1.09% versus a global benchmark, and just under 1% versus a regional benchmark. Strikes, similar result, where we saw about 0.9% decrease over the 7 days and compared to the global, and about 0.74% compared to the regional. And I think one of the great things about this data set is there's so many different variables that we can ultimately look at, right? Here we just see what that dispersion looks like against the various benchmarks, but we can also understand things like, well, what if we wanted to understand whether the stock price responded more to a reputational event or an operational event, right? And we actually see some interesting signals there as well. So as you might guess, reputational events tended to have a more immediate impact on stock price, whereas operational events tended to have a more lasting impact. So when we shift our attention to credit spreads, another interesting result, and here we see, of course, the frequency of events is a little bit limited because our universe is limited based on the parameters that I set before. But ultimately what we see here is the credit markets don't necessarily respond as robustly to ESG events, and sometimes we actually see a reaction that is not entirely intuitive. So overall, again, we saw a high frequency of strikes and pay disputes. Those actually, on average, led to spreads widening, whereas oil spills, on average, led to spreads tightening, which is, I think, a surprise result. We can then distill this again, this idea of pulling out, a variety of insights. We looked at operational versus reputational before. Here we're looking at how different regions might ultimately respond, right? So we've broken the events down by region, by type, and also by company. And ultimately what we see here is that YPF, for example, in Latin America, had one of the biggest impacts on their credit spreads, 13.04 basis points. In response to a labor issue, right? So even though we may see, on average, the reactions to strikes not being that profound across the industry, maybe this sends a signal that investors in Latin America or investors in YPF specifically have a concern about this one topic. So just to provide another example, another industry to look at this analysis through, packaged food, another example of a cheesy title, Unpackaging Packaged Food. So here we're looking at stock price again, and again, the frequency of events and the average impact on stock price. So the most frequent event is product recalls, probably not a surprise. And on average, we see some impact on stock price. Ultimately, the issue that kind of met the threshold of having both a high occurrence and also an interesting kind of impact was strikes and pay disputes. But going back to product recalls, which we'll get into a little bit more, we ultimately see that product recalls led to about a 0.2% decrease versus the regional benchmark over that 7-day period, and a 0.3% versus the global. So again, here we see the regional dispersion, and I think there's some interesting things to pull out. Mandated recalls, when we look at that relative to the industry benchmark, actually created a bump in returns, which is, I think, an interesting one to kind of think about why that might occur. And then again, going to the credit spreads analysis, so similar results in terms of the frequency, but here we actually see product recalls leading to being essentially the only event type in the industry that leads to credit spread widening. And again, this idea of being able to take this data set and really dig deeper and think about other additional insights, we wanted to understand, okay, we understand that recalls are important, the only type of event that on average produce spread widening. Is there perhaps a difference between the type of recall, right? So then we looked further, we saw for mandated recalls versus voluntary recalls, there is a significant difference. So certainly those that are mandated, as the slide here articulates, had a much bigger impact on credit spreads. So I went through a couple different industries that are the two industries that we've done this analysis for to date. Thinking about next steps, we're planning to roll this out for an additional 28 industries, basically to bring total coverage to 30 industries. I think then we're going to surface this as a key kind of data set on our dashboard on the Bloomberg terminal, BI space ESG Go. And then I think the other piece of the puzzle that we'll look to fill in is, okay, we understand these events can have significant impacts on credit spreads, stock price. What might we look at to predict whether an event like that would happen? So we've done some preliminary research in this area. It's called our predictive ESG work. And we looked, for example, at total process safety events and seeing whether that could be an indicator of higher chance of oil spill in the following year. And in fact, that relationship actually did bear out. So we're going to continue to produce additional research to that end. So just to summarize, I think it's pretty clear that this type of research provides yet another piece of the puzzle in trying to answer this ever important question about the link between ESG and financial performance. I think when we look at the ultimate results, it's also quite clear that not all events yield the market response that we might have predicted, which is certainly important to understand. And then even within that, you need to understand the industry-specific events and also how different investors ultimately respond, whether it's credit versus investor, and also region by region. And with that, I'd like to conclude, and I'll leave up on the slide here some QR codes for our weekly podcast. Thank you very much.
Please welcome to the stage Sue Lloyd, Vice Chair of the International Sustainability Standards Board, for a conversation with Bloomberg's Alistair Marsh.
Hi, thank you very much. Hi, Sue. Let's start, if I may, by setting the scene. ISSB is another acronym in the verbiage of ESG professionals. And for the uninitiated, I've made sure I got it right. It's the International Sustainability Standards Board, right? And just a bit of history, it was created or launched by the IFRS Foundation at COP26. 2 years later, there was the IFRS S1 standard, which is sustainability, general sustainability disclosures. S2 at the same time was climate-related disclosures. And then 2 years after that, April of this year, there was a proposal for amending the S2. There's a 60-day comment period, and that ends tomorrow. So this conversation is very timely. That's a whistle-stop tour. Did I miss anything?
There's lots of other details, but that's a pretty good start.
Those are the highlights. Okay. Now, I said this is a timely conversation. Actually, we were just discussing there's some news out of the UK and GRI, both very recent, hot off the press. Could you tell us briefly about them and why they're significant?
Sure. So thanks, firstly, for having me. And I think just to set the scene, maybe before I talk about the UK, I think the other important data points and to build on your story are the rate of regulatory adoption of the standards around the world. So since we published our standards 2 years ago and since we've been in existence for 3 years, we've now got more than 36 jurisdictions around the world who have either decided or are in the process of deciding to use our standards, and they represent more than 50% of global GDP and more than 50% of global greenhouse gas emissions. So we're now well on the journey to actually having this reporting on sustainability, including climate, mandated around the world to make sure investors have got comparable high-quality information. So within that context, one of the 36 jurisdictions is the UK, which is obviously an incredibly important capital market in the global stratosphere. And so yesterday they launched their consultation. So this follows a process that's been undertaken in the UK where a technical group has gone through S1 and S2 to make a recommendation on whether they felt that they should be applied in the UK as the basis for sustainability reporting. They've recommended that they are applied in the UK with alignment with our S1 and S2 standards, and yesterday the consultation was opened to enable UK stakeholders and global investors to comment on whether they agree with that recommendation. Right. So a really important moment to move UK further down the path of regulatory reporting. The other thing that you mentioned, which is an important announcement actually hot off the press just this morning, is as the Global Reporting Initiative, as the global standard setter for impact reporting, set out today their updated standards on climate reporting, we're really pleased to announce that GRI has agreed that they will accept disclosures on emissions prepared using our S2 standard as being other disclosures which are necessary to meet their impact disclosures on emissions. That's a lot of words. What does that mean? It means that if you're a company that's using S2 and you also want to report to stakeholders beyond investors using GRI, great news, you only have to prepare your disclosures on greenhouse gas emissions once using the ISSB standards, and you can use those disclosures to comply with the GRI standards. And for those of you who know about calculating greenhouse gas emissions measurement, including Scope 3, that's not an easy thing to do. So being able to do that once and meet 2 sets of requirements at once is a huge, huge win for the market, and we're really excited with that announcement today.
Great, thank you. Well, I'm keen to ask you about S2, but I'd like to say at this point that we will make some space for audience questions. So if you have some, please submit them through the app. Okay, S2 is the climate piece. As I mentioned, we're coming to the end of a sort of a 60-day review period. But I want to ask you, I guess, what's the purpose of this revision? And should it be concerning at all that it's only 2 years since it was launched, that it now needs amending?
I think quite the opposite.
How come?
Yeah, I'll explain.
Please.
So when we announced the new standards, S1 and S2, we did that knowing that this was an enormous change in reporting for everybody around the world. So many are used to doing sustainability reporting, but not necessarily for capital markets, not subject to regulation, not subject to assurance, and not where we ask for things like information on climate to be linked to information in the financial statements. It's a whole new level of seriousness. And so one of the commitments that we made as a board when we issued our new standards was that we stood ready as our #1 priority to provide the market with the support they need to get on with this journey to apply our standards and to apply them well. So we said from the start, if you've got questions or concerns, here on our website you can submit questions and we'll take action if we think we need to. As a result of what we've heard in the market, we've issued a lot of educational materials where we haven't made changes to the standards, but where, for example, we've explained how to provide information about greenhouse gas emissions using the Greenhouse Gas Protocol in a way that's compliant with S2, because we heard lots of questions about that. But then we heard some questions about some application challenges that we hadn't been aware of at the time that we published S2. So as a sort of grown-up responsible standard setter, we have decided that it's appropriate to make targeted amendments as long as they don't unduly disrupt those who are busy implementing the standard, if we think we can provide targeted relief in a way that really won't upset the quality of the information provided to investors. So we took the hard decision as a board to propose making some targeted amendments to a very new standard because we had said we would be there to help if we needed to. So I'll give you a couple of examples of what's in this exposure draft. They're very targeted amendments. So for example, in S2, we ask for calculations of greenhouse gas emissions, and we had mandated the global warming potential figure you need to use to do that calculation. We said it needed to be the latest figure produced by the IPCC. What we've realised as we've started talking to jurisdictions is that many of them ask companies to calculate their emissions for other purposes, and they don't always use such an up-to-date global warming potential factor. So we're proposing that if you're in a jurisdiction where you'd have to do a calculation using a different figure, we'll let you to use that figure to comply with S2 to provide a cost relief, because we didn't think it was a big disadvantage for investors. So it's very targeted, hopefully you can see from that. The one that's grabbed more attention, I think, which is why you're asking me the question, is that one of the clarifications that we've proposed in S2 is around which category 15 scope 3 emissions you have to provide disclosures about. So which emissions on your loan book or your underwriting activity or your insurance-based emissions, if you're an insurer, do you have to provide scope 3 emissions calculations for? Not an easy calculation to undertake. Now, when we finalised S2, our intention was that we would only require disclosure of emissions for loan books and investments, not for facilitated emissions, your underwriting activities, and not for your insurance-based emissions, because at the time we made that decision back in 2022, our assessment was that the measurement methodology and attribution thinking behind that was still being developed. It's relevant and useful information, but measurement was nascent for those categories. And at the back of the standard, you can see clearly that was our intention, but unfortunately, and I'll take ownership of that, at the front of the standard, it wasn't totally clear whether that was the intention or not. And so we got the question, do I read the back of the standard or the front of the standard? Do I have to do this calculation or not? So to take away that confusion, we've really proposed to clarify the standard to say, this is what the intention was when we drafted, so you don't have to have a long conversation with your auditor about whether you have to provide this number or not. We're just clear it's not required. You could do it if you wanted to, certainly relevant information, but if there's another way to provide information about your transition risk on your insurance business, etc., you can use a different piece of information. So it's a clarification. It's there to help.
Great. Well, I'm glad you got to the facilitated emissions piece, because that, as a financial journalist covering banks, I'm particularly interested in that piece, and the sort of the finance versus facilitated is a very interesting discussion that we don't really have time for. But on the facilitated piece, which is basically the emissions enabled by your capital markets activity, there's always been a sort of philosophical discussion about, do these emissions really belong to me? Should they be attributed to me or not? And there was, my colleagues and I, we followed the development of the PCAF standard on facilitated emissions, and there was a lot of debate about what should the number be. Should it be 33%, 100%? Should it exist at all? But some banks, HSBC, Citigroup, I think Goldman, but I need to check that, they do publish facilitated emissions numbers. So should one take away from the review that is not useful information, or it's irrelevant to the market?
No.
Or more that it's just at your own discretion whether you think it's of value?
It's certainly not a judgment on the relevance or the decision usefulness of the information. At the time that we made the decision back in 2022, what we were being really careful with in the standards, again going back to my sort of earlier comment that this is a huge change in reporting, we're trying to get the balance right between our ambition and what's practical and pragmatic and realistic for people to do. And so at that moment in time, we felt that given all of these conversations that you're alluding to about what the sort of philosophy is behind facilitated emissions, how should you do these attributions, are they really your responsibility or not, that it was a little bit early. Now, that's not at all suggesting that this isn't relevant information, and certainly we'd be delighted if those who have started with those disclosures were to include them as part of the S2 disclosure that they use. I think the important point is that the sort of starting ask in S2 is provide the information which is useful for investors to understand your transition risks. You still have to do that. That hasn't been changed by these proposed amendments. All we've taken away is the very specific ask that you must include as a piece of that information, the information on facilitated emissions. But you need to still meet that need. Somehow you need to explain your transition risk. And you might choose that facilitated emission disclosure is still the best way to do that, but we're not saying that's the way you have to do it. That's how I would position it.
Some people also say financed emissions are not very useful for getting a view on transition risk either.
They do. And I would say that they are quite a blunt tool because it's a very, very absolute measure and I've said publicly before, if I was a bank, I'd probably want to provide extra colour about, okay, which parts of the business am I lending to? Do I have conversations with this counterparty about their transition plans and their ways that they're reducing emissions and what their strategy is? Do I attach conditions to my borrowing? Am I having those conversations with management? I'd probably want to provide that colour, but it is still something which is a proxy for transition risk. If you are lending to these types of industries, how are you managing the credit risk exposure that might come from the physical risks or the transition risks the real economy is facing? And how might a regulator respond to that over time? We're trying to get a picture of that, and it's a proxy. It's not a perfect measure, but it's a proxy for transition risk, and so that's why it's there in the standard.
Okay. A common thread through all the conversations this morning and throughout all the events I've been to at Climate Week is sort of the geopolitical divergence, you could call it, the US heading in one direction and Europe in the other. And in the early days of ISSB, and I'll be interested if you still use this language, there was a lot of talk about sort of creating a global baseline for sustainability disclosures and a kind of a common language that could be used by all. Given the sort of, how can we put it nicely, the sort of the obliteration of climate policy in the US and the European omnibus process, should we kind of be kiss goodbye that idea for good? Is that long gone? And if so, like, what's the consequence of that?
I certainly haven't kissed goodbye to that ambition, and I use the term global baseline in every second sentence, so it's still a thing.
Okay.
And I think what's really important, if you think back to that moment that you referred to at COP in Glasgow when we announced that the ISSB would be created, that was driven by a demand from investors in particular for information to enable them to feel confident that they could assess how climate risks and opportunities, but other sustainability risks and opportunities as well, might affect the trajectory and the performance and the prospects of a company over the short, medium and the long term. And also because companies need to attract capital to do things that they want to do in response to those risks and opportunities. And there was patchy reporting, it wasn't comparable reporting, and so people said, can you please help to make this a more efficient and effective system to underpin the efficiency of capital markets? And that need from investors has not gone away. That need doesn't go away because of changes in politics. And we still see very vocally bodies like PRI just last week talking to the Korean Sustainability Standards Board. It's on their LinkedIn posts, telling them that they should stay with the ISSB's global baseline. We still see the likes of Neuberger Berman, Norges Investment Bank and CalPERS publicly supporting the ISSB's global baseline as part of the EU omnibus decisions, because investors still need to understand how companies are governing, what their strategy is, or how they're managing these risks, how are they going to deal with physical climate risk, let alone the transition requirements that they might have. And those needs haven't gone away. And also, companies, when we talk to them, also understand, at least well-governed companies, understand they need to be on top of these risks and finding opportunities to have a sustainable business in the long term. So there's an interest in understanding these risks and opportunities from a business perspective. And often when I'm out talking to companies, they note that they've learned things about their businesses when they're applying our standards. So I think that investor need, that corporate interest, and backed by an efficient reporting system, that hasn't gone away.
Okay. The need hasn't gone away, and the underlying issues haven't gone away, but it does seem that the climate, to use that pun, in which we operate has changed a lot, right? And I just wonder if, the US retrenchment on climate and DEI and other topics just has lasting pernicious, you could say, or certainly if you care about these issues, knock-on effects on sustainability reporting and these topics around the world?
It would be easier if it wasn't the environment, let me be honest.
Yeah.
But I think what it does mean is that we have to be really careful as a standard setter to ensure that what we ask for is really decision useful. It's really valuable for businesses. It's really valuable for investors. And if that market need and efficiency is there, I think that can underpin a global baseline. It's away from policy and politics and sort of fashion. I think that it increases the need for that efficiency aspect.
Okay. And one question about the ISSB itself. In this sort of multipolar world where we have different jurisdictions going in different directions, I understand that you're still sort of pushing and pulling for this global baseline. But how does the ISSB remain relevant in a world where it's the foundations on which it exists would be loathed in some places, or at least not welcomed?
Well, I think capital markets are global. And so this need for a common set of information and the ability to compare and decide whether you want to invest in a company in the UK, Japan, China, Canada, Singapore, Australia, Nigeria, that exists irrespective of politics. And so I think that underpinning is still there, and that's why there's still a demand for the work that we do. So as long as we keep that look at efficiency, and I think as long as we're really careful to be policy neutral, which we are, we just say, just tell us how it is. We're not judging whether you're good, whether you're bad. That's for others to think about. Just tell us what it is. And I really think that we can see that that policy neutral, efficient focus that meets investor needs is holding true.
Let me ask you just one last question. The previous panel, the one before Eric, was about 1.5. And obviously that's a critical discussion that is taking place in all kinds of fora. What's the relevance of sort of the world's trajectory for 1.5 for the ISSB's sort of standards and disclosures?
Well, to the extent that companies are planning to reduce emissions and targeting 1.5 or whatever their version is, our disclosures help investors and companies communicate and understand how a company's plans will reduce emissions, enable investors to ask the questions about how successful they are in achieving those targets, and assess performance over time. And actually, and we've got negative minutes left, but one of the important things that we published this week actually at London Climate Action Week was new guidance on good disclosures about companies' plans, both to reduce emissions but also to adapt to climate change for resilience, and that information to inform investment decisions, to make sure that banks and others have got the information they need to understand climate transition, including how well we're doing collectively on that ambition, is underpinned by that sort of disclosure.
Fantastic. Sue Lloyd, thank you very much.
Thank you.
Alistair, Sue, thank you so much. We're bringing Global Baseline back today at the summit. We are about to head into our lunch break, and we have a lot of fun stuff going on. For those of you who are already registered to attend our Meeting the Moment, Modern Energy Systems for an Electrified Economy, sponsored by Schneider Electric, just head out of this room, go back down those stairs to the 6th floor, make a right, look for the fish tanks and the signs, and we'll get you into the room you need to be in. We are also offering tours of our award-winning sustainable office and also the London Mithraeum that's below it. So if you have signed up or if you're interested in signing up, just head to the welcome desk that's right outside this room, and my colleagues will get you all set up for tours at these designated times. And we also have a really dynamite facilitated networking session coming up with some of Bloomberg's most powerful ESG and climate professionals. So the way these work, at 1 o'clock, just same out in the space out there, you can choose your own adventure. So just pick the topic that's most interesting to you, and we will have our Bloomberg facilitators there leading small, casual group discussions. This year we have the politics of ESG, led by Sarah Wells, sustainability reporting, led by Eric Kane, who you saw up here earlier, and climate technology with Claire Curry from BNEF. So very excited for this group. So just at 1 o'clock, head over there. And then one final thing, and then I won't stand between you and your food anymore. We are offering eligible attending companies at the summit. You can redeem 6 weeks of corporate access to Bloomberg.com entirely free for up to 100 colleagues. So please scan the QR code behind me if you'd like to take advantage of that offer. We're also going to be sending these details out during in our post-event email to you. So if you don't catch it here, keep an eye out for that email, and we'd love for you to sign up. All right, we will be back here at 2 o'clock with a riveting afternoon program, if I do say so myself. Please enjoy lunch, and thank you so much.